Silver, Thursday, 1980, the day the exchange pulled the ladder. Imagine you're holding the hottest trade on earth. Silver is screaming upward, headlines are everywhere, and people start believing the price can't go down because there isn't enough metal. Then the rules change. This is the crash people still whisper about like a ghost story. Silver, Thursday, March 27, 1980. Silver had run up toward $50 and then collapsed toward $10, $11. The core idea that haunted traders after wasn't just the bubble popped, it was this. The exchange tightened the game when the game got dangerous. Here's the lesson, burn it into your brain. When silver becomes too crowded, too leveraged, too emotional, the market stops being a price auction and becomes a risk control event. 2008. The crash that had nothing to do with silver. Now imagine the opposite scenario. Silver isn't collapsing because of silver. Silver collapses because everything collapses. 2008 was the sell what you can, not what you want era. Banks are wobbling, credit is freezing, and investors aren't thinking about store of value. They're thinking about margin calls. When margin calls hit, people liquidate whatever has liquidity. Silver had been up around the low $1.20 earlier that year. Then it got dragged down into single digits around $9 in late October on many feeds. This is the most important thing you can understand about silver crashes. Most crashes are liquidity events, not value events. Silver gets sold because it's tradable, because it's liquid, because it's there. 2011, the Margin Massacre. Imagine you're long silver, and you're not just long, you're leveraged long. You're using the futures market like a rocket booster. Silver rips toward its famous peak near $50 again. The trade gets crowded, the excitement gets loud, and then the oxygen gets turned off. In late April and early May 2011, CME raised margin requirements repeatedly, forcing traders to post more cash for the same position. Reuters documented that margins were raised 5 times over a short window, totaling about an 84% increase. And here's what margin hikes do in the real world. If you have extra cash, you survive. If you're maxed out, you get liquidated. And when thousands get liquidated at once, the price doesn't dip. It falls through floors. That year, silver didn't just drop for a day, it bled. And by later in 2011, it was back down around the $20 on many measures. 2011, the COVID flash. Paper down, physical gone. Now imagine the weirdest kind of crash. One where the chart says silver is falling, but the real-world product disappears. March 2020. Panic everywhere. Stocks melting, people scrambling for cash. Silver gets hammered, and the Silver Institute noted an intraday low around $11.64 on March 18. But while paper silver was getting dumped, something strange happened on the ground. Physical demand spiked so hard that retail products sold out in multiple places, including U.S. mint coin disruptions in that period. This is where Western silver investors learned the phrase they still repeat today. Spot price is paper. Premium is reality. 2026. The new era crash. $120 plus to what just happened. Now we get to the one that made you click this video. Late January 2026. Silver goes vertical and prints above $120, with Reuters reporting spot silver hitting around $121.64 at the highs. And then almost immediately, it snaps back violently. News coverage described silver dropping roughly 15% plus off those extremes during the sell-off window, with some market reports putting it near the low $100 on the flush. So what's the hidden truth? It's not one secret lever. It's the same old blueprint, just faster now. Positioning gets crowded, everyone discovers the same trade. Liquidity thins, buyers step back at the worst moment. Stops trigger, sell orders become automatic. Forced selling cascades, margin plus leverage plus panic, and the chart looks like it fell off a cliff. And in 2026, the speed is the story. Modern markets don't move like stampedes. They move like dominoes because the selling is increasingly systematic.